Are you relying on dividends for your passive income? In this video, I'll show you how to spot the hidden risks that could lead to a dividend cut before it happens. If you're building a portfolio for long-term income, few things are more frustrating than waking up to news that one of your companies just slashed its dividend. Suddenly, your expected cash flow drops. The stock price might tumble too. Even worse, it often feels like these cuts come out of nowhere. But here's the good news. With a bit of know-how, you can catch many warning signs in advance. Today, I'll walk you through clear, simple steps to help you assess dividend safety so you can protect your hard-earned passive income. Why is this so important? Well, dividend investing is popular because it provides regular cash payments. For retirees or anyone looking to supplement their income, those payments are a lifeline. But not all dividends are created equal. Some companies pay dividends they can't really afford, at least not for long. When those unsustainable payments get cut, investors are often left disappointed. Let's get started with the first sign to watch out for: the payout ratio. The payout ratio is simply the percentage of a company's earnings that it pays out as dividends. For example, if a company earns $2 per share and pays out $1 per share in dividends, the payout ratio is 50%. This metric is easy to find. Just look it up on most finance websites. A payout ratio that's too high, say above 80%, can be a red flag. It means the company is returning most of its profits to shareholders, leaving little room for unexpected events or investment back into the business. Let's take a real-world example. In 2019, a major retailer, Macy's, was paying out nearly all its profits as dividends. Their payout ratio hovered above 90%. When the pandemic hit in 2020 and earnings dropped, the company was forced to cut its dividend entirely. Investors who looked at the payout ratio ahead of time could have seen this risk coming. But a low payout ratio doesn't always guarantee safety. Some industries, like utilities or real estate investment trusts, REITs, naturally have higher payout ratios. So always compare a company to its peers. Next, let's talk about dividend yield. Dividend yield is the annual dividend payment divided by the stock price. For example, if a company pays $1 per year in dividends and the stock trades at $20, the yield is 5%. It's tempting to chase the highest yields, but a yield that's much higher than average for that industry can actually be a warning sign. Why? Because the market may be pricing in trouble ahead. Let's say most utility companies offer a 3% dividend yield, but one stands out with a 7% yield. Before getting excited, ask yourself why. Is the company's business struggling? Is there news of declining profits? The high yield could simply be the result of a falling stock price as investors worry about the future. A classic example is General Electric in 2017. Its dividend yield spiked as the stock tumbled, and not long after, the company announced a dividend cut. Investors who focused only on yield and ignored the underlying business missed the warning. Now, let's move to cash flow. Earnings are important, but cash flow tells you how much real money is coming in the door. Companies need cash, not just accounting profits, to pay dividends. Look for free cash flow, which is the cash left over after a company pays for its day-to-day operations and capital investments. If free cash flow is consistently less than the dividends paid, that's a big warning sign. Consider the case of oil companies during periods of low oil prices. Some continued to pay dividends even as their free cash flow turned negative. Eventually, many had to cut payouts, disappointing investors. You don't have to be an accountant to check this. Many financial sites show free cash flow and dividend payments side by side. If dividends regularly exceed free cash flow, dig deeper. Another area to watch is the company's debt load. Companies that take on too much debt may look fine when times are good, but when profits dip, debt payments can squeeze out dividends. A good rule of thumb is to look at the debt-to-equity ratio, which compares how much the company owes versus what it owns. If this number is much higher than competitors, or if debt has been rising sharply, be cautious. For instance, in 2015, Kinder Morgan, a large pipeline operator, had a growing debt burden. To pay its dividend, it had to borrow even more money. Eventually, it had to slash its dividend, and the stock price plunged. Investors who watched the debt levels could have seen the risk ahead of time. Let's talk about business fundamentals and earnings trends. A company's ability to pay dividends depends on its ongoing profits. If earnings are falling year after year, at some point, the dividend could be at risk. Look for consistent revenue and profit growth over several years. If the company's sales are flat or declining, ask why. Are its products or services becoming less popular? Is competition eating into its market? For example, in the early 2000s, many newspaper companies paid strong dividends. But as internet advertising grew and print revenues shrank, these companies saw their earnings erode. Eventually, many cut their dividends as profits dried up. Also, be alert for one-time gains. Sometimes companies report high profits because they sold part of their business or got a windfall. If those profits aren't likely to repeat, the dividend could be at risk next year. Now, let's define a few key terms we've been using to make sure everything's clear. First, dividend yield. This is the yearly dividend divided by the stock price. It shows how much income you get for your investment. Next, payout ratio. This tells you what percentage of profits is being paid out as dividends. A high payout ratio means less room for error. Finally, diversification. This simply means spreading your investments across different companies and industries. If one dividend gets cut, it won't devastate your entire income stream. Don't put all your eggs in one basket. Even the safest-looking dividend can be at risk. So, let's recap the key steps to spotting hidden dividend cut risks. First, check the payout ratio. If it's too high, the dividend may not be sustainable. Second, look at the dividend yield. Yields much higher than peers can signal trouble. Third, examine cash flow. If dividends are consistently higher than free cash flow, be careful. Fourth, watch the company's debt. Higher rising debt can squeeze out dividends in tough times. Fifth, pay attention to business fundamentals. Declining sales or profits are red flags. And finally, don't forget to diversify. Even the best research can't guarantee a dividend will never be cut. If you follow these steps, you'll be better equipped to spot risks before they impact your passive income. Remember, no investment is ever 100% safe, but with a little homework, you can stack the odds in your favor. If you found this video helpful, please consider liking the video and subscribing to the channel for more clear, practical insights on dividend investing. And if you have questions or want to share your own experience with dividend cuts, leave a comment below. I'd love to hear from you. And just as a reminder, this is not financial advice. Always do your own research and consider speaking with a professional before making investment decisions. Thanks for watching, and I'll see you in the next video.